Let's talk about the 2026 real estate market. Because if you think you know the rules, well, you might want to think again. Everything's changing. We're going to dig into 3 huge, and I mean huge, structural shifts that are flipping the script on how we all rent, buy, and sell property. Let's dive right in.
So what is really happening out there? I mean, yeah, prices are up, we all know that. But it goes so much deeper. The entire engine of the market, it's being rewired right before our very eyes. And to really get what's going on, you've got to look past the splashy headlines and get into the numbers. The real story is in 3 major changes. We're going to go through them one by one, and by the end, you'll see this completely new landscape taking shape.
Okay, first up, shift number 1. It's all about the real reason for those rent hikes. If you've been looking at your rent payments lately and thinking, wait, why is this going up again? You're asking exactly the right question. Because the why behind it all, it has completely changed. Okay, so for the longest time, right, rent hikes were all about demand. You know the deal. A killer location, a shiny new building, maybe it's right next to the train station. Landlords could charge more because people wanted to be there. Simple. But that's the old way of thinking. Now we're in a completely new ballgame called cost push. What that means is owners are getting hammered with rising expenses for everything. And they've hit a tipping point where they can't absorb those costs anymore. They literally have to pass them on to tenants just to keep their heads above water.
And look, this isn't just a hunch. The data backs it up big time. This survey is really telling. Check it out. For single-person apartments, more than half of all real estate agencies are expecting rents to go up. But then you look at family-sized places and whoa, that number jumps to nearly 60%. That is a huge consensus. The pressure to raise rents is everywhere, and it is real.
So what kind of costs are we talking about here? It's not luxury stuff. We're talking about the basics. You know, repairing an air conditioner or replacing a water heater. The cost for that has just gone through the roof. Same for renovations to keep a place from looking dated. And on top of all that, you've got rising property taxes. In the past, an owner might have just eaten some of these costs to keep a good tenant. But now, that's not really an option anymore. The numbers just don't work. Keeping the rent flat now literally means the owner is losing money every single month. Okay, so let's pivot from renting to buying. Because this whole cost pressure thing, it's causing a massive ripple effect in the sales market, which brings us to our second big shift, the great migration to used homes. And here's the core of the problem. It's actually pretty simple. The price tag on building a brand new house has just exploded. We're talking materials, we're talking labor, everything is way more expensive. So you have these prices for new homes just climbing and climbing, but people's paychecks, they're just not growing nearly as fast. It's created this invisible ceiling, this affordability wall that a lot of buyers are just smashing into.
So what happens next? Well, it's a pretty clear chain reaction. First, buyers who dreamed of a new place find they're priced out. They have to give up on that idea. But they don't just vanish from the market, right? All of that pent-up demand, all those people, they flow right into the next best thing, the used home market. All of a sudden, those properties start looking like a pretty good deal in comparison.
But here's the twist. The used market isn't some magic solution. We're already seeing some red flags pop up. Take a look at this chart. It's what's called a diffusion index for land prices, which is just a fancy way of measuring how optimistic people are. The higher the bar, the more people think prices will go up. So right now, things are still in positive territory. But look at the forecast for just 3 months out. See how much that bar shrinks? That's a huge drop in confidence. It's a big signal that even though today feels okay, people are getting really nervous about what's coming next. And this is the key takeaway here. The used market isn't this perfect escape hatch everyone might have hoped it would be. All those buyers fleeing the new home market are now flooding into the used home market. But here's the problem. There just aren't that many used homes for sale to begin with. So you get this massive squeeze. Too many buyers, not enough homes. And what happens? Prices for used homes start shooting up too. And just like that, you've got a whole new affordability problem. It's a tough cycle. This all leads us to our third and final major shift, the widening urban divide. Because these intense cost pressures, they're not being felt the same way everywhere. Not at all. What we're seeing is a market that's splitting into 2. You have areas that can take the heat, and then you have areas that are frankly getting burned. And this table just lays it out in black and white. On one side, you've got the strong areas. Think of places like the Tokyo 23 wards, Chiba, and Fukuoka. These are the economic powerhouses. There are plenty of jobs, incomes are higher, and the market is strong enough to basically absorb these rising costs. But then, you look at the other side.
You have areas where there's already an oversupply of housing and weaker demand. For property owners there, passing on higher costs is almost impossible. It's a brutal squeeze that puts the entire local market at risk. And there's one more thing that's like throwing gasoline on this fire: rising interest rates. This quote from the survey really says it all. There's a lot of anxiety out there. Think about it. When it gets more expensive to borrow money, you get way more careful about where you put it. Your mortgage payment is higher, so you're going to get laser focused on what feels like a sure thing. And for most people, that means prime urban areas that feel like a safe investment. The flip side, all those other regions get hit with a nasty double whammy: fewer people and rising costs, which just makes them look way too risky for many buyers. Okay, so let's pull all these threads together. We've got rent hikes driven by costs, a huge wave of buyers moving into the used market, and this growing split between strong cities and weaker regions. So what does it all mean? What's the one big idea connecting all of this? For as long as I can remember, real estate has always been about one thing: supply and demand. That was the golden rule. But that's not the main story anymore. Seriously, the old playbook is being completely rewritten by a much tougher economic reality. So the new number one question for the market is this: who has the ability to bear costs? It's that simple. And this question applies across the board. Can an entire region handle higher prices? Can a property owner actually afford the rising maintenance bills? And most importantly, can your personal finances handle a higher rent or a bigger mortgage? In this new game, it's all about financial strength. That's what really matters now. It really forces you to think about real estate in a completely different way, doesn't it? When inflation is the dominant force in the economy, everything we thought we knew about property value and what's affordable gets put to the test. So, I'll leave you with a question to chew on. In an age of rising costs, what's your take on it all? So there you have it, a look at the new rules that are reshaping the 2026 real estate market. If you found this breakdown helpful for understanding what's going on, do me a favor and hit that like button. And of course, subscribe for more deep dives just like this one. Thanks so much for watching.